Hello, my name is Behrend. I'm the President and Chief Investment Strategist of the Insurer Family Student Managed Fund representing Penn State Erie, the Behrend College, and this is our video submission for the Engage 2015 Stock Pitch Competition. On today's agenda, we're going to walk through our investment philosophy, a little bit about the company that we're pitching, and then finally we're going to finish with our evaluation. I'm now going to turn it over to Ryan Mitcheltree, our Senior Vice President of Market Analysis, and he's going to give you a little insight into our investment philosophy.
Before we get into our company overview and our example of our valuation, I first want to give you a brief overview of our investment philosophy. At the Student Managed Fund, we place a high value emphasis on fundamental analysis. By this we mean we examine companies' financial statements, industry growth, and peer analysis. We use sources such as Value Line, Thomson One, and IBISWorld. For a basic requirement, we have our stocks have a potential 8% minimum appreciation. Additionally, we also examine rewards and risks. We have our analysts examine certain internal and external factors that could potentially impact the value of our stock. Next, I will have Aaron Philbeck discuss the company overview and the in-depth evaluation of our stock.
The company we are pitching today is Freeport-McMoRan, ticker FCX. It's a natural resource company that was founded in 1912 in Freeport, Texas, under the name of Freeport Sulphur. Deals primarily in commodities including copper, gold, and oil, and has a large international presence in the United States, Chile, Peru, and Spain. The reason why we want to buy this stock is because the valuation is compelling, with a 32% potential appreciation. Commodity prices are also at multi-year lows, which adds to this valuation and has a high dividend yield of 6.07%. Additionally, the stock is down 50% since last year due to perceived bad acquisitions and multi-year commodity prices being at a low point. There are some risks to this stock as well, including a possible dividend cut due to the falling price of oil, has a large international risk in Indonesia, who's threatening to remove their export permit, and they're also especially sensitive to commodities, since 60% of their revenue comes from different types of metals. As you can see from this graph, the exposure to commodities has an effect on the stock price and has a large correlation to gold, copper, and crude oil. Next, I'm going to walk you through our valuation. But before we do that, I'd like to walk you through our calculation of our cost of capital. The cost of capital method that we use is the capital asset pricing model. And on this graph below, you can see some of our assumptions, including the risk-free rate, which we pulled from the 30-year Treasury yield, our equity risk premium, which we pulled from Dr. Damodoran, who's a professor of finance at NYU, and the beta, which we calculated using 3-year historical weekly data compared to the S&P 500, which gives us a cap-in required return of 12.36%. The method that I would like to walk through today is the two-stage declining free cash flow to equity valuation. As you can see in this chart, we have a few assumptions, including our current earnings per share based on the 2014 data of $2.05. We also have our growth rates, which we pulled from IBISWorld, of 10% for the first 4 years and a terminal growth rate of 3%. Additionally, we have some other assumptions which we pulled from Value Line, including our debt financing, which just includes the long-term debt to its capital structure. And again, our required return of 12.36% from our cap-in valuation. As you can see from this chart as well, we have some more assumptions, including our earnings per share growth, which is declining at an equal rate of 1.75%, going from our 10% initial growth rate down to our terminal growth rate of 3%. Our fixed capital investment is also pulled from Value Line, which are projected out 5 years. Once we take out any fixed capital, working capital, or debt financing expenses, we have our future free cash flow to equity valuations for each of the 5 years in the future. We then take those free cash flow to equity valuations and discount them back to the present value, and then calculate a terminal stock price using our terminal growth rate, which comes out to $28.70 at year 4. Then we take that year 4 terminal stock price and discount it back to the present value at time 0. We add up all the free cash flow to equity present values to the present value of the terminal value, and we get a final value of $25.38. This is just a summary of our evaluations, which includes any discounted cash flows, dividend discount models, or industry comparables. We take the average of all of these and we average them together, which gives us a final intrinsic value of $28.22, which is a potential appreciation of 32.63%. So based on our investment philosophy of a minimum potential appreciation of 8%, we are labeling this stock a buy.
Through our analysis of Freeport-McMoran, by using models such as discounted dividend models, discounted cash flow models, and industry copper models, we are recommending this stock as a buy with a potential 32.63% upside appreciation. Thank you very much for taking the time to view our presentation.